This is TreppWire Week in Review for week ending July 22nd, 2022. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Henry, Head of CRE and Advisory Services. This week, second quarter earnings offer results that are not as bad as feared. Economic data released this week point to a cooling of the economy. Retail sales, while higher than predicted last month, were driven by higher prices. And the housing market, a bellwether for the economy, is showing signs of a slowdown across multiple gauges, except for multifamily, which is still growing. And two different reports, jobless claims and the Philly Fed, show that the job market is loosening a bit. And U.S. consumer sentiment still hovers at an all-time low. Manus, as we head into next week's Fed meeting, there is a lot of data to digest.
There sure is. That high-pitched sound that you hear coming out of our speaker today is not Lonnie wheezing from that intolerable Texas heat. It is the sound of relief coming from the lungs of investors after this week. Last week, and for most of the second half of June and the first half of July, sentiment was terrible. The inflation numbers have been terrible. We were at the cusp of earnings season, which everybody thought was going to be awful. Fast forward ahead 1 week, and it was a terrific week in terms of things happening that people could look towards and say, you know, maybe there are brighter days coming. So we could run through those very quickly. On the non-economic front, the fact that the pipeline from Russia to Europe opened up was a huge sigh of relief for investors this week. We talked about this last week, that they were rationing energy supplies, hot water, heat in Germany. There were thoughts that the Nord Stream 1, which had been taken down for maintenance, might be used as a political pawn over the war in the Ukraine, and that Russia would not turn this back on. The fact that it went on, I think, was a very big relief. I think it was a little bit underreported in the financial press about just how meaningful that was. I think had that been left off and we were looking at more rationing in Europe, I think then you're talking about social unrest and bigger problems down the road. But there's plenty of other things to look at that felt pretty good. You know, so we'll talk about the good, we'll talk about the bad. On the good side, earnings you referred to, pretty good, right? The bar was set not low enough probably 3 weeks ago. Analysts were really moving very quickly to lower their estimates ahead of earnings season, so they didn't look so wrong when the lower earnings came through. It turns out that a lot of companies were able to beat estimates. I think this is a little bit dated. This is from 2 days ago, but earlier in the week, FactSet was reporting that of the first 10% of companies that had reported, 2/3 had beaten estimates. And, you know, that included Netflix. Well, Netflix was more beating on cancellation numbers than the revenue numbers, but that was a positive. Today, Tesla was a positive. All of that led to just a happier tone for the market. 4 straight days of gains for the broader indexes. Also another reason for optimism. And let's not leave out treasuries, which have been fairly range bound for the last 2 or 3 weeks between about a 285 and a 305 10-year. And the more that stays range bound, I think the more comfortable people are that the economy is not coming off the rails.
Yeah, all good points, Manus. And I think they, do paint a little bit rosier picture than what we maybe had anticipated a couple of weeks ago. I would just say that to Martha's, intro, the housing market has started to maybe show some signs of tumbling. So I have a few stats that we'll look at there. So in the macro, housing starts have fallen 2% to a seasonally adjusted rate of 1.56 million units last month, which is the lowest level since September of 21. That was from the Commerce Department. Single family starts were down 15.7% from June. We start looking at available inventory. So we have a kind of a case study here over the last 6 months. Housing inventories have really started to explode in some of the, really hot post-COVID markets. So Denver saw a 247% increase in homes on the inventory available list. Austin's up 220% in terms of available homes. Colorado Springs, 195%. Stockton, California at 175%. And Boise, which had kind of been the pandemic darling, was up 161%. Those numbers, on their face don't necessarily translate into anything, but when you start looking at time on market and price reductions and everything, it starts to paint a little bit of a more dreary picture. So roughly 1 in 7 homes in June that were listed on the MLS had a price reduction. Just for comparison, in June of 21, only 1 in 13 homes had a price reduction. So pretty significant increase there. And then it says 13% of builders who participated in the monthly NAHB, so National Association of Home Builders survey, said they'd reduced home prices over the last month to lure buyers and slow cancellations. So I think there's definitely some clouds on the horizon for the single family market. Building permits were also down, so they're an indicator of future construction, declined 8% to a rate of 967,000 units, which is lowest since June of 2020. That bullet here, mortgage demand fell more than 6% last week, hitting the lowest level since 2000. That was published by the Mortgage Bankers Association. The one bright spot here, though, was multifamily. Starts for housing projects with 5 units or more actually rose 15% to a rate of about 568,000 units. And we're up pretty significantly, 16.4% from a year earlier. So kind of a mixed message there in terms of single family and multi. But I think we're starting to see that. I think we're going to talk a little bit later about some of these. You went through the earnings. There were, in addition to some of the earnings, some large announcements. Ford announced, depending on who you looked at, that they intended to cut several thousand jobs. Some of them said they were going to cut up to 4,000. A few others said 8,000. So we've talked about the last couple of weeks, if we start seeing layoffs or people losing their jobs, that usually bodes very poorly for the single family housing market, which may actually continue to contribute to that low consumer sentiment that we talked about at the intro as well.
Well, let's stick on the residential for just a second, because, I'm a tourist in that market, other than the fact that I live in a house. I don't watch the data as much as most, but there were 2 things that jumped out at me this week. At the recommendation of one of our listeners, he suggested I listen to a gentleman named George Noble, who has his own podcasts. I guess you can find them on Twitter. I only listened to this week's, which was Residential in Nature, and he had researcher Ivy Zellman on, who you see on CNBC and quoted in Barron's periodically. And he, I think, by nature is bearish from what I could gather. Ivy, I'm not sure what her standard belief is in the market, but she was putting out some data points that were extraordinary. 35 and 40 and 45% cancellations of contracts in places like Boise, which you mentioned before, Phoenix, which she says is right now ground zero for cancellations. I think it was either 36 or 44%. So for those that are looking for where the economy might be decelerating the most, that's a worthy podcast to listen to. It's a little long. I think it was more than 2 hours, but really chock full of data on the residential side. And we do know that, from 2008, which was maybe the worst we ever see, that can metastasize and move on to other markets and have bigger impacts. Another person that was out there this week with very bearish sentiments, Mark Zandi of Moody's, who is their chief economist, who also said that even though the U.S. may only suffer a modest recession overall, that residential is already in a recession. So he too putting out the call there that residential is getting quite messy quite fast.
Yeah, we've seen it in Texas here. It's been a really hot market, and it's a tale of 2 transaction types. You still have some price points where the houses are flying off the shelves, and then you have some of these more speculative or under construction builds where builders had to absorb those high lumber costs a few months ago, increase pricing, and then now consumers can actually get a better deal going and buying an existing home in some markets. And so they cancel on the builder and they go and buy something that's in the inventory. And so it'll be very interesting to see. I think the data is still too new to really see, to your point, man, it's like how far or how deep this will actually spread. But if you're not paying attention to it, you should probably start at least looking at what's happening in your local market, because that usually is a pretty good precursor for the overall health of the economy.
Absolutely. And it does spill over into commercial real estate to the extent you talk about multifamily and also what people are spending, right, in your local community, what they're spending on a house, or, as values fall and people can get things cheaper, sometimes that is a tailwind to the economy over time, but that'll take some time to play out. Two more thoughts on the broader economy before we get into specific property type things. Going back to the lead, I talked about this being a very good week for the market. Everybody calmed down, and a rising stock market will do that for you, right? The NASDAQ is now up 12% from its trough of a couple of weeks ago. But, this market can turn on you very fast. And what I sense the sentiment is this week is, and at least this week, is investors are locked into this thesis that the US economy is slowing very rapidly. That will force a leveling off of inflation. And we may be seeing it in residential already, sounds like it. And that in turn will force the Fed to show some restraint later in the year, right? That we will have this virtuous cycle that the dominoes will line up and all these things will happen. And by early 2023, we'll be off to the races again. We'll have a growing economy. But sentiment can change quickly, and a more aggressive Fed next week or negative comments from them on what they're seeing, or a bad CPI print next month, and then it's back to panic city. So I would not put an awful lot of weight into 4 days worth of data.
So I was going to add two other data points related to commercial real estate. One was data that was put out by MBA that said total commercial and multifamily mortgage borrowing and lending is expected to fall $733 billion this year, down 18% from 2021's number of $819 billion. And our own very unscientific LinkedIn poll asking folks what they thought the trend for the delinquency rate was, which, if you recall, ticked up last month. More than half, 64% of those respondents said that it was a sign of an inflection point. And I guess we'll find out next month if that indeed is the case.
Yeah, I mean, a quick hint on what we're seeing, one more positive thing, which the market hasn't seen yet, hasn't digested, is the data we saw this month in CMBS. We haven't pulled it all together yet, but there was nothing catastrophic about that, right? We didn't see this wave of distress out there. And 1 month does not make a trend by any means. But for people who are looking for February 2008 all over again and subprime, where the wheels come off over a very short period of time, we didn't see that with the July numbers in any way, shape, or form. But I'll leave you with one more cautionary tale, piece of data that I looked at during this week. And we tend to look at these CPI numbers year over year. That most recent headline number is 9.8, right? Extraordinarily high and concerning. But when you look at the 2-year number, it just really blows you away right now. When we were in early 2022, the February, for example, CPI number was like 2%. And then when you stack on top of that an 8% number that came out in February this year, it meant the 2-year CPI growth was about 10%, right? Because the 2021 numbers were so modest. But now we're getting into this window where the year ago numbers were 6 and 7%. So when you stack 2021 and 2022 on top of each other for June, it's 16%, right? By June of last year, we were already up to 6.1%. When you add that to this month's 9.8, you're up to 15.9%, 2 years over, which is just extraordinary. So even if we manage to corral this and get back to 6% by a year from now, that will still represent almost a 25% increase in prices from 2021 to 2023. It just blows the mind.
And we talked to our friend Brian Bailey, who's a commercial real estate specialist for the Atlanta Fed. We talked to him last Friday, actually, right after the retail sales number and consumer sentiment numbers came out, and got his thoughts on what was happening in the market.
I think that there's just uncertainty right now around some of the dynamics in commercial real estate, and that is impacting lending. Talked to a number of lenders recently where they're saying it's just a little bit harder right now to read the tea leaves around where values are going to. end up. There are a lot of them that foresee a shift in cap rates. We've seen upward pressure, upward movement on Fed funds because of the decisions of the Fed to get inflation under control. That certainly has impacted other rates, i.e. the 10-year treasury. It's impacted the rate associated with the 30-year fixed mortgage. And so we've seen those rates move up. And at the same point, we've not seen a whole lot of movement in cap rates right now. A little bit of it is it's early, that cap rates tend to lag. And so in that respect, we're seeing some omen, some signs that volume is declining, which in my mind is kind of a precursor, a pre-step to seeing a movement in cap rates. The other thing I'd say is that the index, one of the indexes I track is provided by Green Street, and they not only cover transactions, but they also cover appraisal values. Their index has pretty much been flat since January. In the last couple of months, they have begun to show a little bit of decline in pricing.
All right, we're going to start with retail, which has lots of green shoots. So get your green on, Manus. I think we're going to start, first of all, we should start with the comeback story. And, you had the Hoosier music a couple weeks ago for the Durst building. I think this week we need Rocky music for Toys R Us.
Who doesn't love Toys R Us, right? It was an activity when your kids were between 3 and 7, right? If you didn't feel like navigating the Applebee's and, getting in and out of the car, trying to keep your kids from fidgeting for 25 minutes while you were waiting for the blooming onion to come out or whatever their 2,700 calorie appetizer was. Toys R Us was just a great, great activity. Hop in the car, let kids run around for a while. Everybody gets one thing. Hopefully it doesn't cost $400 or it doesn't shoot BBs at 100 miles an hour. And back in the car and it's bedtime, right? Who doesn't love Toys R Us?
Yeah, so I have some funny life stories about Toys R Us that we can get into at a later date, but it's interesting. They're making a comeback. They're going to open up new locations in Macy's department stores from late July through October 15th, kind of a pop-up store concept. These are in-store shops. They're going to range from about 1,000 square feet to 10,000 square feet in their flagship locations. Some of these locations will include Lenox Square in Atlanta, State Street in Chicago, Ala Moana in Honolulu, Memorial City in Houston, and a few others. So yeah, it'll be very interesting. I don't know if it has the same appeal when you're dropping your kids and you're running into Macy's to catch the Toys R Us vibe as it did when you pulled up to that really nice Toys R Us, magically lit naming sign out front on the top, and you jumped in the cart and let your parents push you around and try to grab everything on the shelf. But hopefully this is maybe the start of something new, Toys R Us 2.0.
My only downside for Toys R Us was that one of my kids was a real Lego guy, right? Every time we went for Lego, and he was pretty accomplished. Like, he didn't need my help. He could put them together by himself. I think people in the audience know I'm a pretty rated G guy. I don't use the 4-letter word very often. And the only 4-letter words my kids ever learned were after I would step on a Lego piece first thing in the morning with bare feet. I think that was probably the only 7 to 10 times in my life.
You said darn.
That my kids heard darn or gosh or golly, doggone it.
That's a 4-letter word, darn. And, while we're talking about retail, there were numbers put out by CoreSite. And we've talked about this before, that we haven't talked about store closures, and the numbers have come in for the first half of the year. And overall, there were over 4,300 store openings and only about 1,900 closures for the first half of the year. So retail continues to be resilient in the face of some real challenges the last couple of years.
Yeah, and the data we're showing at a very granular level this week kind of underscores this. And you may ask, why are we starting out with the retail? Everybody knows the retail story. Part of it is that we've been so heavily focused on office lately. We wanted to change it up this week. But we also thought there were a lot of green shoots there to offset some of the negativity that we've had due to higher interest rates and people thinking that we're at an inflection point and so forth. So I'll run through some of these very quickly. In Bowling Green, Kentucky, there's a $57 million loan on the Greenwood Mall there. New comments from the special servicer this month indicate that the mall should sell at a price that will generate sufficient net proceeds to pay off the loan. That's a great outcome for a Morgan Stanley deal from 2012. What makes this even more positive for those investors? It's also a CMBX 6 deal, by the way. The collateral had been lowered from 105 million in 2012 to just 47 million in 2020. So with the loan being outstanding at 57 million, they're expecting a payoff of substantially more than what this property was appraised for 2 years ago. First green shoot. Number two, the Waterfront, which is a property in Homestead, PA. It's a regional mall. That loan, another CMBX 6 property, another CMBX 6 loan, that was slated to mature in October 2022. That paid off early. It paid off with the July remittances. The shops at Boca Park, this is in Las Vegas. The value of the collateral was actually up. This backs a $73 million loan that's outstanding. It's a legacy loan. It's been out there for a long time. The property was valued at only 42 million a year ago. The servicer data this month showed that being bumped up to 50 million. If you're bondholders in BSCMS, that's Bear Stearns, by the way, not only a legacy deal, but a legacy firm, 2005 Power 7, your ship has come in. You're going to get a lot more proceeds out of that sale than we talked about last year. And then lastly, and this we're going to offer up as a freebie, we'll call this a mixed green. We sent this out as a trading alert Monday. And this is about the Grease Ridge Center that backed a $61 million loan that was part of a 2010 deal. Why did this catch our attention? Well, the modification pushed out the maturity date 4 years. It now matures in 2024. It was supposed to mature in 2020. The loan was bifurcated. If you don't know what that means, it means it was split into an A note and a B note. The B note represents about 20% of the outstanding debt. And as I said, the maturity date was pushed out. Why is this mixed green? Well, on the positive side, this property was only valued at 36 million most recently, according to a broker appraisal. The fact that the owner of the property is on the hook for a $50 million A note shows that they think this is worth more than 36 million. That's positive number one. Positive number two is the borrower wants to keep this asset. They were willing to work with a special servicer to keep this thing. The crabgrassy part of it is that $11 million, that B note, good chance you never see that back as an investor. It's kind of a loss waiting to happen. So that's kind of the retail micro this week and some good signs there.
Yeah, man, those were some good retail stories. And I know the headlines have not always painted the best picture for the retail, property sector at large. But even with some of the doom and gloom and even with some of the challenges facing the overall CRE market, it hasn't really stopped the commerce or transactions of retail properties, in the marketplace. So I have a few that I'll highlight here in a segment we're going to call retail sales. Centennial Lakes Plaza in Minnesota had a Whole Foods anchored center that just sold for $68.75 million, which was about $345 a square foot, according to the Biz Journal. Bradford Shops in Cary, North Carolina, another grocery anchored center, sold for $42.2 million. That was about $555 a square foot, also courtesy of the local Biz Journal. Greenleaf at Cheltenham in Wyncote, Pennsylvania, formerly Cheltenham Square Mall, $69.5 million, $173 a square foot. That was up from the $29 million transaction that took place in 2014. So that's a really big green shoot there. Two more here, Fullerton Town Center in Fullerton, California, $102.5 million, which is $466 a square foot. That's courtesy of the Ocean County Biz Journal. And then the last one here is Center Place of Greeley. This is in Greeley, Colorado. Almost $38 million, coming in at $37.55 million, or $247 a square foot. So there's five, sales that fairly geographically diverse across the U.S. that just indicate that, these properties can still generate high prices in the market. Investors still, feel there's value in these particular asset classes. So I think it's good. I'm glad that we've highlighted some of the nice stories about loans being able to turn themselves around. And then some sales here, over $500 a square foot in one instance for a retail grocery anchored center. I think it just paints some good picture on the retail sector.
Let's just stick on that Cheltenham for 1 second. That's a great story. This property once backed a $55 million CMBS loan in 2004 from one of the big REITs. That was one of their properties. This thing sold for $29 million, as you said, Lonnie, which resulted in a nearly $20 million loss for CMBS investors. This is the kind of mall that is it's going from 29 to 20 to 15 to 10, and it ends up in the hands of Cohan or Namdar. The fact that somebody paid $70 million for this thing, 133% of where it went for a couple of years ago, it's just a great story. It might be the best retail story we've heard in the last 6 months.
So I was going to piggyback a little bit on the sales front to, look at properties even outside the retail sector. So I know last week we talked a lot about some of the doom and gloom in the marketplace, but there was a nugget that caught my eye this week. Dallas-Fort Worth metro area was ranked as the top U.S. property market in terms of sales transactions in the first half of 22. So commercial property sales in North Texas were up 54% in the first 6 months of the year. Almost 23 billion in total transaction or sales price volume. Dallas-Fort Worth led the country in real estate investment, topped Los Angeles, Atlanta, Houston on the list of nation's biggest commercial property sales and investment markets. DFW property sales included apartments, offices, industrial, and retail. So again, I didn't pull out any of the individual retail property sales for this particular market, but DFW really has stood out the first 6 months of the year in terms of being a very active transaction marketplace.
And before we move on to another property type, the freebie we're offering is the modification document for that Greece Center loan. So if you're interested in educating yourself about what a modification looks like, we've shared some of these before. You could reach out to us at podcast@trepp.com, or any of us individually, Haley, Martha, Lonnie, or me, or reach out to us on Twitter, and we'll make sure that you get that and you can get a sense of what these things look like, because they're quite interesting.
So let's go to our friends in the office sector. Starting out with a story that was published in our own sister publication, CRE News, basically covering the national office sector performance in the second quarter. Cushman & Wakefield said that office suffered from a 7.8 million square feet of negative absorption during that period of time.
Yeah, so over the last 9 quarters, national office markets had positive absorption only one time, and that was in last year's fourth quarter. And I think they referenced about 1.17 million square feet was absorbed to the positive. But negative absorption has been the headline. And effectively, it's when the vacancy of previously occupied space doesn't get absorbed by new tenants moving in or new participants taking that space down. So, this is not great news for the office sector. This is just another storm cloud that's been hanging over. Seeing it quantified in this regard, I know we've had a couple of the podcast listeners email in saying how we've talked a lot about downsizing over the last couple of episodes, and had we gone through an exercise, maybe adding up some of those downsizing square footages, et cetera, this puts a pretty big number on that in terms of negative absorption. So a couple green shoots to talk about in office, a couple crabgrass. The office sector has been resilient to this point. So even in spite of the negative absorption, there are still transactions happening and still leases being signed. But I do think that gives a pretty sobering perspective of where the market is right now.
Yeah, certainly more crabgrass this week than green shoots. And I think that's been kind of par for the course for the last month or so, right? A lot of subleasing going on, a lot of downsizing, to your point, Lonnie, and some real negative headlines there. And that really continued. You really can't do a Google search for office leasing without, on that first page, 2 or 3 stories showing up. Detroit, record levels of sublease availability. Phoenix, record levels of sublease. I think last week was Atlanta, and a couple of other places as well. So by no means is it limited to 1 or 2 cities. This is really kind of spread its tentacles, this subleasing trend and this negative absorption throughout the U.S. We'll run through a couple of crabgrass stories, and we can talk about what little green shoots we have. In California, Salesforce is now talking about subleasing 400,000 square feet, which is about half of Salesforce West on Fremont Street in San Francisco. That comes from the San Francisco Business Times. Salesforce actually owns that business. About 350K will be listed next month, and the rest will be available in December. In the Research Triangle area in Raleigh-Durham, Advanced Auto Parts is ending its agreement with the state of North Carolina. Advanced Auto Parts had received economic subsidy promises if it had met agreed upon conditions for adding employees to headquarters in that area. That is now off the table. That comes from Jason Parker of WRAL TreppWire. One headline that got a lot of attention this week: Meta and Amazon, they were announced to have pulled the plug on several expansions. Facebook in particular was looking to add 300,000 square feet at 770 Broadway in New York. That's now been put on ice for a while. Amazon doing the same. We saw this week also Microsoft announcing that they were going to level off employees, no more employee growth for the foreseeable future. You might recall a week or two ago, we announced that they were going to be giving up space in Bellevue, 500,000 square feet, if I remember correctly. So a lot of stuff out there in that crabgrass category.
Yeah, I think it's interesting. It kind of begs the question, if we go back a couple of years, you remember the old HQ2 frenzy that took place after Amazon announced it wanted to expand and have another headquarters, and the cities were basically putting together, pitch decks and other things to lure them to their locations. And, this Advanced Auto Parts story kind of, makes you look at that and say, that's a pretty small potato compared to Amazon. But a lot of these cities have given away a lot of economic development dollars, tax abatements, et cetera, to get these office giants to come into their cities. The downside of that is when they decide to pull the plug or maybe slow down, if you have too much of a concentration of those types of tenants, it can really decimate your overall footprint. So if I look at like Austin, Texas right now, in the last 5 years, they've probably seen 5 or 6 million square foot of new office development for Apple, Amazon, Facebook, Meta, Indeed, some others. They have a really high concentration of single tenant occupied tech, type of office tenant. It just makes you wonder, if those things start to go south, how do some of these secondary cities that have really come to prominence survive over the short and medium term? Because there's not a backstop or an alternative of tenants that maybe want to move in and take that space down.
One more story I wanted to touch upon, which had potential negative implications for the commercial real estate finance market for offices. It hit our wire today, and we're going to be writing about it. It'll be in tomorrow morning's TreppWire. And this is about the Greenway Plaza in Houston. That particular property is enormous, first of all, 4.5 million square feet spread across more than a dozen offices in Houston. It backs a $465 million CMBS loan. That loan backs a single asset deal. The property was valued at about $1 billion 5 years ago, 2017, give or take, which should be a pretty good valuation, heavy on energy tenants, and the valuation came after the energy bust, right? So this is not a case where that $1 billion came in 2013 and reflects a $140 a barrel oil price, right? So that $1 billion is probably a fair price. And yet, May came and went. The loan was not refinanced. It was supposed to be refinanced by this month. A 2-month forbearance had been granted to the borrowers. That was missed as well. The borrower has now asked for another 90 days, but that's just a way station for what they hope will be an even longer extension down the road. And I think we've been all racking our brains, not just us here on the podcast, but listeners, all over, what is going to be ground zero of the office market and what is going to be the first domino to fall. And if this property can't get refinanced, a loan that was underwritten with a 45 LTV, which is still almost 90% occupied, with a pretty lengthy rent roll, then that we may have more problems in this office market than we think we do right now.
Yeah, that's a very interesting bellwether property, man. So just to give the listeners some context there, Occidental Oil and Gas at the time of origination occupied about 940,000 square feet. They have leases that run through 2026. Invesco Management Group had about 400,000 square feet. They had initial lease terms expiring in December of 23. Transocean Offshore Deepwater Drilling was about 260,000 square foot. Large scale tenants, to your point, historical occupancy on this building has always hovered around 90 to 92% occupied. You know, nothing seems outside of the norm for this particular property. It doesn't seem like performance has fallen off. What's interesting is if you look at the sales that were used in the appraisal at the time of that origination, just to validate your point of the value being a legitimate value, sales prices, the prospectus had about 5 or 6 property sales. They range from $178 a square foot to $385. None of these would seem outlandish in today's times. We've seen office buildings in Houston and Dallas over the last 6 months. Some of them have sold for, $500 a square foot. This obviously is a lot larger complex with multiple buildings, but, to me, I agree with you. There's nothing on this that makes you feel like this had been propped up at origination and never performed. This property is effectively, doing what it's done for the last, several years. And if it can't refinance, it does probably not bode well for the market office at large.
There's been a lot of coming and going in that property. And my recollection is that at one point Occidental was thinking about moving out of that particular property. And maybe that's hanging over the refinancing, the fact that they may say one of these days, yeah, we're going to move on after all. That's the only thing I can think of here. But, the people that are really getting probably disappointed by this turn of events would be the Class A owners of the $306 million bond that is backed by this property, the GSMS 2017 GPTX. That bond has a coupon of 2.85%, right? So here you were thinking, this thing's going to roll, we're going to get our cash back, and we're going to be able to put back to work something in the 4 or 5% return. And you may end up holding on to this piece of paper for a considerably longer period of time than you thought.
All right, I'm going to move on to hotels. And we have, looks like a lot of green going on there.
We do have a lot of green. We haven't talked about hotels very much lately, but before we got to that June CPI number and sentiment turned so negative, we were talking with a great deal of admiration for the rebound of the hotel segment. We had been talking about how the delinquency rate had really come down sharply. Loans were curing at a really high pace, and loans were leaving special servicing. Valuations of collateral were rebounding at a really nice clip, and we got more of that this week. We'll talk about a couple of those very quickly. One of the loans, a bigger loan out there that had been issued in 2016, was the Equity Inns portfolio loan. 174 million outstanding recently. When it got up to its October 2020 maturity date, it couldn't refinance. We were in the throes of COVID. The borrowers got a 2-year extension that was to end in October 2022, but the loan paid off in July this month in full. So what was once a big liability for the CMBS market now gets paid off. So positive story there. Love this one. About a week ago, we wrote in TreppWire about hotel owner-operator MCR acquiring the DoubleTree by Hilton Hotel in Tallahassee. At the time, we didn't know how much they paid for it, but we have since got that sales price. And the beauty of this is not only is this REO asset going to pay back in full the outstanding debt on the loan and all servicer advances, fees, expenses, special servicing costs, but also paid off was a prepayment premium. Talk about your comeback. This was an underwater loan looking at probably a 10 or 15% loss. I'm sure that no bondholders anywhere were expecting a prepayment premium as part of this payoff. And yet here we are. $1.2 million penalty being passed through the cash flow waterfall.
Yeah, that prepayment penalty equates to about 5.3% of the loan balance. So it was a sizable prepayment premium that was incurred. So just to piggyback off of that MCR acquisition that you just outlined, Manus, in a press release, they also announced that they had received a $420 million loan to refinance a portfolio of about 30 hotels that they currently own and operate, which was about 3,800 rooms across 17 states. Majority of the properties were in high growth markets in southern states, Florida, Texas, South Carolina, et cetera. Locations range from leisure destinations, Hilton Garden Inn, Orlando at SeaWorld, to urban assets like the Courtyard by Marriott Milwaukee downtown, as well as university driven markets. So, I think you highlighted MCR really, for the bondholders on this particular deal, and the Florida hotel, we're pleased. They've been making some moves in the market at a broader level with their portfolio as well. So I think this just bodes well for the hotel market at large. Anecdotally, as you guys know, I'm on the road quite a bit, and I can tell you over the last 2 months, stayed at several hotels that were actually undergoing extensive renovations, which is usually a pretty good sign of a healthy hotel market. So, operators, to keep their flag, have to do, PIP plans on a recurring basis and come in and renovate. And I think a lot of those were put on hold during COVID for obvious reasons, but it's good to see those things. Not convenient sometimes when you're traveling, but good to see for the industry that those improvement plans are starting to be put back into place.
In our last shoot, we could let our listeners decide if this is a green shoot or crabgrass. I guess it depends on where you sit. This came in from Ann L., who checks in with us periodically, and she's located in Europe. She sent us a link about the Mandarin Oriental in DC selling for $373K per key. That story is from Market Watch. If you're an optimist, you're saying 373 is not the 200K per key you've been getting in New York lately. And you thank goodness that Washington is not New York when it comes to hotel sale prices. If you're, glass half empty, it's, that 373 is considerably lower than what we've seen in other hotel sales in the past in Washington pre-COVID. So I guess from my perspective, it's good to see commerce taking place and hotels clear. Is part of the pricing discovery process, and that's good. But I think we all wish this was a 450K or 500K per key sale, that's for sure.
All right, a couple quick programming notes. There's one more week, maybe less than, to sign up for Trepp's hosted affordable housing community call, and send us a note. We'll give you the information of how to register for that. And once again, our series sentiment survey is out. We've gotten some really good commentary so far. So if you haven't filled that out, send your notes to us. We will include all of that in one of our upcoming podcasts and share that broadly. Shoutouts, you mentioned Ann L. She gave us some more crabgrass stories in hotel. Dennis B. mentioned industrial outside of California. And honestly, we've run out of time today, but we had a bunch of data points that we were going to cover next week on industrial transactions.
I have more industrial, Dennis, than you can shake a stick at.
There you go.
Next week is your podcast.
There you go. And John F., Christian D., Matt, aka Oz, he said it was quite a story this past week on the pod with all the examples of office tenants giving back space. We've been reading stories of downsizing and you've been reporting on it. So he wants us to do more and maybe save all those up for some adding up of square footage totals. So we might have to hire someone to listen to all those podcasts. We've been reporting on that. That'd be some real work. Ian M, a loyal LinkedIn follower, Jeff S, Joe D, Yankee Clipper, when we talked about our mob names, he had a number of suggestions. So he was very creative. Manny Manuch for you, Manus, which I thought was interesting. And Lonnie Leverage. And I don't know why I'm Martha Misdemeanor. What does that mean exactly? Like, why can't I rank felony? We
also got Lonnie Bracco instead of Donnie Bracco from
which is perfect,
from movie
right?
fame.
If he had
Perfect.
only known that it should have been Lenny, then we all would have been that much better off.
I got to
That-
tell you, the shout out from Joe D just got me thinking about baseball. Right. And, anytime I hear from Joe D, I always think of the Yankee Clipper. And setting everything aside, like we talked about it being a good week for the financial markets, for sports fans like me, this is the most dismal week of the whole summer. Right. I would rather watch a staring contest between Martha and Lonnie than the home run derby.
Oh,
Right. There's no live baseball on Monday. The All-Star game, it's just kind of a snore. And then you got no games on Wednesday and Thursday. It's just kind of, it's bone
You
dry.
didn't watch the ESPYs, apparently? No
I
ESPY
don't know,
watching
like,
for you?
Can you guys do a staring contest and break up the monotony for this week? It just,
Did you catch the Derek Jeter Captain 7-part documentary? Episode 1 was on this week and pretty cool. It's good to kind of hear the story behind Derek Jeter because he was so good at staying out of the public spotlight. It's kind of cool to see behind the scenes of him. Always a fan.
You know what was on this week? The Pride of the Yankees with Gary Cooper playing Lou Gehrig. And the movie's only loosely based on truth, but it's got the quote that everybody uses at the end where, he says, "I'm the luckiest man on earth." And there's the echo. I thought for sure you would have been watching that.
I watch a lot of sports movies. There's no doubt about it. Slapshot, Rudy, Hoosiers. I got called out because I always misname the high school Hoosiers. One of our shout outs said, I'm always calling it Hickory Creek when it's just Hickory. It's really true for me. I can't believe there's not a network devoted to just sports movies. Like, what is that?
That'd be ideal for you, right?
That's right.
That'd be perfect for All-Star Home Run Derby SB Week.
That's right.
Just binge on it. And one more shout out from BB Dogged Tenacity, who sent us the New York Post article about Gen Z and millennials want boomers to just go home so they can take over the workplace and get rid of corporate jargon and boomers that look down on them when they take PTO. And
I don't know. I mean, with this COVID thing, it's been a long time since been in an office and kind of, I just have a tough time with flakiness in general. I think work hard, play hard, try to win as a team, try to build good products, try to get accurate data. Anything worth doing is worth doing well. I've been lucky in my career that I've worked with teams that was their mantra, from the minute they walked in the door to the minute they left. And I could talk more about that in a future podcast. We saw some wonderfully positive, emotional stories about that. But I don't have a lot of patience for people that want to jog to first base.
no jogging. Fast run. With that, we'll close. Thanks to our producer, Haley Keene. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or comment or something you want to ask us, send an email to podcast@trepp.com and subscribe to the podcast with your favorite provider. Thank you for listening and stay well.
All right.